Hello, everyone, and thank you for tuning in. I have the pleasure of speaking with Macan today. Macan is the co-chief investment strategist with Manulife Investment Management. Macan's going to provide us with a current update on the market environment and share some market statistics. You have all heard from Marty and I that volatility is normal. Now is not the time to panic. We continue to encourage you to stay the course. And today you're going to hear from Macan some statistics that help support that advice. So without further ado, I'm going to pass it over to you, Macan.
Thanks, Brendan. Thank you for that introduction. So let's just get started right away because I know we have 10 minutes to do this. So I want to start off with a quote. And the quote is, if you make the mistake of looking back too much, you aren't focused enough on the road in front of you. Said by Brad Paisley. Had no idea who Brad Paisley was until my wife told me, but clearly I'm not a country music fan, but the quote is important nonetheless. And it's important because investors do this, both with good returns. They'll take good returns that they've earned historically, extrapolate those forward. And what investors are doing today is they're doing the exact opposite. They're looking at their returns from the past 9 months, which unfortunately have been negative, and they're extrapolating that forward for not the next year, the next 2, the next 3, and so on. And there's dangers in doing that because often where we're coming from is rarely where we are going. So the first part, for the next 3 to 5 minutes, I'm going to talk to where we are today, what to expect for the next year. But more importantly, the last couple slides are for investors in terms of meeting our financial goals, things we should do when we see periods of volatility like this, and things that we should not do in periods of volatility like this. As you can see we'll start with the global backdrop and we'll go to our heat map. And our heat map is a gauge of manufacturing across the world. I won't go into the details, but they ask managers in each one of these countries questions related to the health of their business. Are you planning on hiring? What are your input costs doing? And so on. Green is good, yellow is neutral, red is bad. Far left-hand side is August of 2 years ago. Far right-hand side is August of today, or 2022. You can see the transition of the global economy over the last couple of years. As you can see on the far right-hand side, the global economy is weakening. It's weakening from peak levels that we experienced last summer. That should not be a surprise given how interest rates have increased, how commodity prices have increased, how inflation has increased. And this is actually, as counterintuitive as it may sound to you, bad news is good news moving forward. And I will explain that in a couple of slides. Now, we may get a recession. Our indicators are pointing to that we may get a recession in Canada and the US at some point early next year. But as the next slide shows, we believe if we get a recession, the recession will be mild. Why? Is for everything that points to recession, one aspect that points to resilience is the consumer. We are looking at the consumer health from the US in this next slide. So we're looking at income growth, we're looking at consumption, we're looking at savings rates, and we're looking at wage growth. The blue is where we are today. The red is where we were prior to COVID. And with the exception of a few, one can make the case that the consumer today is in a more resilient position than they were going into COVID. Now, yes, higher interest rates. We know the Bank of Canada raised interest rates by 0.75, higher commodity prices. It is going to have an impact on consumer spending. But all this means from our point of view is if I had $1 to spend, I may have 95 cents to spend now. But I don't have zero. Unemployment has not shot up. If anything, we're at multi-decade lows. We believe that this trend will continue. So if we were to experience a recession, it will be mild. And one could argue that the negativity that we've already experienced in our returns this year is factoring that in. Markets are forward looking. Once the recession actually happens, the markets have already priced that in months before. So I think that is actually a good news story. When I say bad news is good news, is that it's already likely been priced in. As you can see in this slide, inflation is a topic of conversations with everyone. And when we look at inflation, and it will be coming up soon, but I'll talk about it and from a big picture perspective, why have markets sold off? Markets have sold off because at the beginning of the year, if you were to ask, markets were expecting at the beginning of the year that central banks would maybe raise interest rates 2 to 3 times this year in increments of 0.25%. And you saw very quickly the market shifted its mood. They shifted their mood that they were expecting interest rates to go up by increase 8 to 12 times this year and in much larger increments. Why have markets sold off? Markets have sold off because markets are worried that the central banks are going to go too fast and too quickly. And that's going to cause a severe recession. We don't think that's going to be the case. We think that with a slowing global economy, as we alluded to in the first slide, with commodity prices coming back down, with the impact of the interest rates we've seen increase actually flow through the broader economy, inflation will tick down. As inflation ticks down, central banks will not be as aggressive over the next year as they have been over the last 9 months. And the very same headwinds we have faced for equities and for bonds for the first 9 months of the year will actually become tailwinds as we go into 2023. Now, Bryn, can you see the inflation chart? There we are. Okay. So as you can see, why do we think inflation is coming down? Is because of our model. Our model is the orange dots. The blue line is actual inflation. Historically, our model has tracked actual inflation well. You can see on the far right-hand side, we got the magnitude of inflation going up because we were one of the few that thought 2 years ago inflation was actually going to be more stickier. Our inflation model wasn't able to capture the magnitude. Now, if you ask me why this is, I don't have an exact answer, but one thing that did not exist in the past 2 decades was supply chain issues. Our model was not able to incorporate that. So I believe supply chain issues are going to dissipate as we go into 2023. And if we were talking 1 year from now, I don't even think we're talking about supply chain issues. So if that led to some of the inflation, and if that inflation comes off, then that gap should narrow. We should see inflation trending lower. Are we going back to pre-COVID levels? Absolutely not. But we're going back to levels that are going to make central banks much more comfortable with inflation. So in a nutshell, it's been a tough 2022. There is no doubt about that. It is probably one of the toughest years on record because stocks and bonds have sold off. That's what happened in the rearview mirror. Looking forward, we think inflation come down. We think that the global economy, although weakening, does not go into a severe recession. And typically, you have to feel the pain to get. So we're in a bear market in a nutshell. We've had 15 bear markets since the 50s. You know what's happened after each one of these bear markets? You get a bull market. And the bull market is much more longer, and the return profile is much more attractive over a longer period of time than the bear markets we typically experience. So let's move to the next one, Bryn, because I think this is more important. What I've said to you, what I've said right now, yeah, that's going to be helpful for the next couple of months. But if you're going to take anything away from this conversation, take away the next 2 slides. The biggest obstacle to investing is us, is our brains. Investing is easy if you're a robot. If you are rational and you lack emotion, then investing is very easy. Unfortunately, we are human. We are very irrational. We are very emotional. And when it comes to our money, take those 2 personality traits and put them on steroids. Now let's go to the next slide, Bryn. Now, when you sat down with Bryn and Marty, actually, let me go back 1 second. How many of you are invested in the markets because you love the day-to-day volatility? Unlike me and Bryn, you've loved the volatility we've experienced in the first 9 months of the year. The answer is no. The reason you invest in the equity markets or markets in general is when you sat down with Bryn and Marty, you said, okay, these are my hopes, dreams, and wishes for 10, 15 years down the road. I have this sum of money today. I can save a little bit every year, but I need this to get to this. So I can have my hopes, dreams, and wishes in 10 plus years. And the markets have provided that return profile over the long run for many investors to reach their hopes, dreams, and wishes. That's what we're looking at here. The green lines are the annual return for the S&P 500, the broad US stock market, going back to 1980. What sticks out to you? What sticks out to me is 80% of the time, markets are up. And in this time horizon, the market return has been close to 10% per year. That's why we're investing in the stock market and general markets, not because of the volatility, because the market has provided a return for investors to reach their hopes, dreams, and wishes. What's the blue dots? The blue dots are the biggest sell-off in any one of those years. So let's look to 2020 on the far right-hand side. That is saying if I put $1 in on Jan 1st, closed my eyes and looked at my statement on December 31st, that $1 would have been up 16%. Despite, and we know what happened in 2020, in the depths of the sell-off in March, markets were down 34%. To me, this slide shows me that markets are up 80% of the time. But the blue dots are telling me the ride is never smooth. And the ride won't be smooth going forward. We typically get 2 5% sell-offs in any given year. We get one correction, which is classified of a sell-off of 10% every 2 years. We get a bear market, obviously a lot less common, thank goodness, but they happen every 5 years roughly. So what we're going through today is not any different than what we experienced during, remember, the COVID sell-off. There's a sell-off in the last part of the year of 18, first part of the year of 16, European financial crisis. I can go countless examples. This is normal market activity. The key is we can't react to those blue dots and sell out of our equities, because if we do, we won't earn our green lines and we won't be able to meet our hopes, dreams, and wishes. And think about the headlines. Yes, the media is trying to educate us, but what's their end game as well? They're business. They're trying to drive ad revenue. They're trying to drive profitability. They know humans react more to negative news than positive news. I think it's evolutionary. I think thousands of years ago, let's just say when me and Bren were cavemen and cavewomen, that if we didn't pay attention to the negative news around us, it led to our deaths. The margin of error was very slim. Thankfully, we've evolved, but I think inherently we pay attention to negative news closer than positive news. The media knows this. They're going to blast negative news as opposed to positive news, and you should be aware of that. So when you get those negative headlines and you might want to react, remember, Macan told me I have to ignore this, the blue dots, so I can earn those green lines. Now let's go to the next slide, because investors are paralyzed today. They know they shouldn't sell out of equities today. They know they should be buying them when they're at a discount. But behavior, it's just counterintuitive. Investors always typically follow the same path. But you are not paid as an investor to be a pessimist. You are paid to be an optimist. And I learned this personally as a lesson early in my career, which was the great financial crisis. And think about back then. If you think today is scary, back then was scarier. Remember? Markets were down 56%. The US market was down 56%. Major international financial institutions were going belly up. We didn't know whether the US financial system, the largest and most important in the world, was going to be around on any given week. So that had a very, obviously early in my career, had an impact on me. I came out of that with a bearish lens. I learned very quickly that I'm not paid to be a pessimist. I'm paid to be an optimist. Why? The data suggests it. I wish I had a crystal ball. I don't. I have probability. And investing is a probability-based decision. 80% of the time, markets are up. What is this showing me here? This is showing me the daily, as you can see on the far left-hand side, the daily, monthly, 1 year, 3 year, 5 year, and so on, odds of being negative, red, versus positive, green, in any one of these time periods. So in a daily perspective, the odds, so tomorrow, example, Friday, will be September 9th, the odds of being positive or negative is a coin flip. It's 52% to 48%. My 2 and 6 year old girls have as equal of a chance of predicting market moves on any given day as I do. But when you sat down with Bryn and Marty, did you say, listen, these are my hopes, dreams, and wishes for the next day, the next month, the next year? No. We looked at time, or you looked at time horizons of 5, 10 years down, or 3, 5, or 10 years down the road. And you see, what does the green line do from daily to, let's just say, even 5 years? Your odds of being positive go from 52% to 87%. What that is saying is in any given 5-year period over the last 50 years, my odds of being positive are 87%. That's why we're invested in the equity markets. That's what we need to remind ourselves during short-term periods of volatility, is not to react to the top part of this chart, because if we do, we won't earn those bottom parts of this chart. And that's what our financial goals are. That's what the end game is. Not the next day or next month, it's the next 10 years. So even for those that are saying, well, Macan, I'm about to enter retirement, it's in 3 years. Well, even look at the next 3-year period. The odds of being positive are 85% of the time. And more importantly is, yes, you may be 3 years away from retirement, but your nest egg also needs to grow throughout your retirement. Statistics Canada stated that, and I couldn't believe this when I read this, so I checked it, but the odds of you or your spouse together being alive by the time you're, I think, in your mid to late 80s, is like 90%. Maybe I need to live a better lifestyle, but the majority of us are going to be spending more time in retirement than we did in our working age. So yes, we may be close to retirement, but our money needs to continue to grow beyond when we enter retirement. So if I could just wrap it up, it's the next, I think it's been a tough 2022. If you asked me how close we are to the bottom of this, it's always hard to predict. But I think if we're using a baseball analogy, because we're in the middle of September and the Jays are in the playoff hunt, is I think we're in the 7th inning. I think we're much closer to the end today than what we were at the beginning of the year or even in March of this year. And that's a positive thing. Not to say we might not experience more downside from here. September has been historically a very bad month for markets. But I ask you, is the next downside of maybe 10%, is that the risk for you not meeting your financial goals? No. The risk of you not meeting your financial goals is not being a part or fully invested for the next bull market, which happens after each one of these bear markets. Now, with interest rates also increasing, we're getting more questions of, Macan, why not just GICs instead of investing in bonds? And I'm going to be quite honest. If you need the money in less than a year, or you need that for the year, then yeah, lock in that GIC rate for 1 year, because it's a risk-free guaranteed return. But if you're using it as a proxy for your bonds with a time horizon of greater than a year, then that might be a little short-sighted. I think you're looking in the rearview mirror, looking at bond performance and saying, well, GICs can get me X%, that's more than my bonds. That's a view in a rearview mirror. You're not looking ahead. 80% of the time since the inception of the Canadian bond market, Canadian bonds have outperformed GICs. So again, the odds are in your favor about bonds outperforming. And it's not like the outperformance is immaterial. 55 to 60% of the time, that outperformance is greater than 2.5%. So think about 2.5 at minimum compounded over your retirement. That adds up very quickly. So I think when we look at going forward, we need to be looking forward. We need to remain optimistic. And if you feel sick to your stomach about your statements or asking Bryn to buy more stocks or bonds, it's typically a good sign that we're near the bottom. When everything's flying high and things are rosy, that's when you should be a little bit cautious. But when things seem dark, and not to use Batman as a quote, but it always seems darkest before the dawn. And we believe we're in one of those periods today. So with that, Bryn, I'll pass it back to you for the conclusion.
Yeah, thank you so much, Macan. Really appreciate you taking the time to chat today. You always do a good job at explaining all the complex stuff to me, and so I'm so glad that I get to share this with my clients. To all of the clients that are watching, thank you for trusting Metherell Financial with your hard-earned money, and we appreciate you taking the time to watch through this video. I hope you feel reassured after hearing Macan and myself remind you that your emotions are normal, but the right thing to do right now is to remain rational. Stick to that long-term plan. If anyone has questions or would like to set up a meeting with me, please reach out. I'm always happy to discuss. And again, thank you, Macan. Much appreciated. And everyone have a great rest of your day.
My pleasure.